Andreas, how are you doing, man?
Doing fantastic. It's a pleasure to be here. Thanks for having me.
Yeah, I'm looking forward to having you on the show. I'd gotten reached out by usually the firm or service that you had started working with, and
Mhm.
came across your bio and some of the things that you've been doing, and I was like, this is going to be a fun conversation. So
Good.
I know you're sitting at WonderKid right now, but there's been multiple things. You've been an employee, and you've also had a couple of your own ventures. Why don't you just give us the Cliff Note version of how you got to where you are, and then we can go back and unpack it.
That's right. Yeah. So I'm at WonderKid now, which I did not start myself, but previously I'd been a founder, a co-founder of 3 different companies. The first one was a medical spa. It was actually Florida's first ever medical spa, which is where you would do like laser hair removal and Botox injections, but not in a doctor's office, but rather in a more comfortable setting. So I started that with my sister, which that was a lesson learned in of itself.
So there's some stuff behind there. We're going to be coming back to that.
Fortunately, it was acquired by a chain of medical spas that was looking to make a bigger footprint in South Florida. So sold it to them in 2011. The next company was a company called Earned It, where we would reward people for exercising. So if you use any of these trackable devices or apps like Runkeeper or Fitbit, Nike Plus, all these, then we would integrate with it, give you points based on how physically active you were, and then just like credit card points, you could redeem them for rewards and things from our brand clients. Yeah, and then that company was acquired in 2013 by this company named Higgy in Chicago. When Higgy itself actually was just acquired last year by a company that is going public.
Oh, cool.
And then after that was a co-founder of a company called Fundera, which is a marketplace for small business loans. That one was not my idea, but my co-founder, Jared, who was the CEO of the company, brought me in on day 0. We raised some money and had a nice outcome last year. We were acquired by NerdWallet. Some of you all might be familiar with NerdWallet or even Fundera. Mm-hmm. And now I am the GM of a business unit here at WonderKid. So WonderKid is a software company. We sell into e-commerce companies and media companies to help convert more of their visitors into customers. So taking that traffic and just making it more fruitful for them. So it's a SaaS-based company. I run a business unit that sells into these media companies, the SaaS offering, but also have P&L remit for an advertising product. So almost like a media business within it. So it allows me to be a builder within this company, right? So as you've heard, I enjoy building businesses, and this allows me to build this business within the confines of a large organization, which, it's a
no
feature
personal guarantees, right?
It's a bug at times. Yeah. So that's how I got here.
Well, that's super awesome. And before we unpack all the way down to where you're doing right now, was it accidental, or how did you get the entrepreneurial bug? Like, when you said, okay, I'm going to go try something on my own, going back to the first thing that you started doing, like, give us, like, what did you have in the email? They called the entrepreneurial seizure, right? So like, how did you go about starting the first thing?
The first one was somewhat out of necessity. So I had, I left New York for a consulting firm. I left New York in 2001, actually right before 9/11. It was August 2001. And then went traveling for a year, came back from backpacking through Southeast Asia, and then began working with my dad. And that was a rather, frustrating experience. Again, just work, you see a pattern here. Working with family can be detrimental. But and so I then began wondering, okay, what's the next step for me when I ceased working for my father's business, because I did want to move away from that. And both my parents are entrepreneurs, small-time entrepreneurs. And I then thought, hey, I was in Miami at the time, saw all of these people with tattoos all over their bodies. And I thought, this was probably now like 2004, 2005. I thought, these people are going to regret those decisions someday of having all these tattoos emblazoned all over them. And Ryan, I think you have some tattoos.
I got a couple. My smallest story about this, man. I remember, I will never forget this, because it was like right after I got one of my tattoos. I was like, my first one was like 19. And I was at Lids back when like malls were
Oh,
a thing. And
yeah.
this guy was like, I'm like, oh, dude, you got a bunch of sweet tattoos. You ever think about putting one of those on your hat? He goes, I hate my tattoos. I was like, oh, dude, this is exactly to your point. I'm like, why is that? And he pulls up his shirt and he goes, this is my ex-girlfriend. And I was like,
Oh,
oh, man.
no.
Yeah, just big
Nasty.
portrait all over his chest.
Oh, that's terrible. Yeah. That's
So I
regret
don't
town right
regret
there.
any of mine, but I know it's a thing.
Yeah, here's the thing. And so, and it's interesting too. So I thought of, oh, people will regret it someday. This was back in 2005. Now, actually, more people are getting
Right.
tattoos and adopting, like accepting them and loving them. So my hypothesis was wrong, but nonetheless, I was speaking to my sister who in Miami. I was saying, hey, a lot of these people are going to regret it. Maybe we should look into tattoo removal, laser tattoo removal. And my sister said, well, I don't know anything about laser tattoo removal, but my good friend Marshall runs a medical spa in Atlanta where they do laser hair removal and laser vein removal. And I
Hmm.
said, what's a medical spa? Started to research it and said, wow, Miami is the perfect market for this. And it did not exist in Miami. It existed in New York, clearly in Atlanta, where my sister's friend was Marshall. So I brought Marshall on as basically kind of a co-founder of the business, so we can really piggyback on his experience. I came to New York several times to visit a bunch of the medical spas here, and then raised a little bit of money. I think we raised about $120,000 and launched that
So
medical spa called
was
Students.
Marshall, you and your sister all partners at this then?
That's right. That's right. Marshall being the smallest one of the three in terms of ownership, since it was my sister and I doing really the day to day.
Hmm.
And it went really well. We had success very quickly. I think I made a very naive, amateur decisions where, I wanted to prove to these investors that trusted in us that they made a good decision. And so pretty quickly after that early success, even just 4 months into the business, I started making distributions back out to them. Like, hey, look, you made the right decision. So
Hmm.
foolish because there was a void in the market for medical spas in Miami. So we were basically the trailblazers there. And what we should have done in hindsight, if I weren't trying to prove myself, was we should have gone out and opened additional locations and really created a stronghold on that market. Maybe even raised more money instead of doing the opposite, which was what I did, which was very sophomoric and juvenile, which is returning that money to think, wow, look, you made such a wise
Were they
move.
requesting it or anything? Or
They
were
were
they
not even, you know what I mean?
really
Like it was
just kind
so
of
just so stupid.
trying to make sure that yeah, the fear of if you've never raised money before, making sure that like, hey, I'm not going to take your money. And
Yeah.
how long did you guys have that business?
So we had the business. So we launched it in '05. We ended up selling it in 2011.
Okay.
I did leave the business. Well, I left to go to business school here in New York in 2007, and then my
Okay.
sister continued to run it. And then ultimately, she started to have a family, and so we had one of our investors' wives managing and running it, which did a great job. And then we were able to sell it. Fortunately, that was an inbound interest in selling it. I tried to find a buyer a few years prior to that, nurturing relationships with other medical spa owners. But then what happened was the medical spa industry took a hit because there was so much competition that pricing started to plummet. We never reduced our pricing. I'm very averse to discounting. I'm much more in favor of premium pricing, premium product, premium experience. And so we maintained that. And it was very difficult to maintain that for a long time, but we did. And ultimately, it served us well because the other medical spas had a race to the bottom and they went out of business, and we maintained and survived, and then were acquired.
What when you said when you laughed about saying that you partnered with your sister, what was some of the challenges that surfaced?
Yeah, I mean, I'll start with when I left to go to business. What happened was full transparency. I had a long distance girlfriend that was very serious. She was in New York. I was in Miami, so I wanted to find a way to get to New York, have a real reason to get there. I applied to Columbia Business School. I got accepted, and that was my ticket. And so I loved New York City. I'd lived there right after college, as I'd mentioned, and so I wanted to get back. And I think my sister felt, this is getting real, transparent, like opening the door. My
Hmm.
sister felt probably that I was betraying her, or just leaving her behind which was of course not my intention nor my motivation in any way, but that was how she perceived it. And so it did create certainly a rift temporarily between us. And we got past it, and wow, it's been a long time now. So
Mm-hmm.
everything's great and hunky dory. But there was a period of time there, I'd say for, several months where it was tough. It was tough.
What's
And then,
and the Well, I
oh,
was sorry to interrupt. I think what's interesting, and to kind of give you some vernacular, that over the years of the podcast and then our business, that there's this concept of ownership versus management roles, that you get like what you get your paycheck for, your wages, versus like, hey, I could have equity in this business and not have to work there. And
mhm.
most people that I see in family business, my dad and I never understood that, Andres. Like, so not you could solve for those things differently. Like, hey, you can like leave, be an absentee owner, but still own equity. Or like, I mean, you had investors that didn't work in the spa, I'm assuming, right? So
Right.
like, and
That's right.
most people that didn't figure that out, do you think that that was part of it, or like
Th-
not understanding the
that
separate?
absolutely, that could have been part of it. And you hit the nail right on the head, right? Like the way to really create yourself set yourself up for financial independence and success is to have equity in things and not necessarily just rent your time out. And I had that epiphany while I was, because I was working at the medical spa full time as an employee, but also an owner. Eventually, I just thought, well, I think once I realized I'd made that mistake of not expanding when we should have, and pretty quickly tons of competition came in, and I saw that there was going to be limited opportunities for growth of the business, and I realized, okay, well, maybe I shouldn't continue to be renting my time out as an employee of the business. Of course, retain my equity stake, but now perhaps go on to bit larger and greener pastures in my mind.
Mm-hmm. Mm-hmm.
And I think my sister did not have that same interest as I did to go move on and just do more and bigger things. She was happy with what was going on there. So I think it was a
Getting the
different.
paycheck and having some flexibility over day to day stuff. And
That's exactly right. That's
what
exactly
was it
right.
like bringing that GM on? And then how did Marshall fit into the whole piece? And I'm just super intrigued on this. I know we're pulling from years back in your memory, and we'll make sure to expedite the journey. But like, I'm just curious because this whole like equity versus roles, it's just such a common issue. So like, how did Marshall fit into the picture? And then this new GM that came in, how did you guys handle that?
Yeah, so Marshall, in hindsight, was probably overcompensated from an equity perspective. We wanted to be really generous with him at the beginning to make sure he wanted to sign on with us and gave us that knowledge dump, and be with us to guide us. In hindsight, he probably did receive too much equity you know for what we received in exchange. So, and then the GM that came on ended up being, after my sister, was the wife of one of our investors. And so
Okay.
there was a vested interest there in making sure that the spa succeeded, so that all the investors could get paid out. But yeah, it gets tricky when you start talking about both the cash compensation and the equity compensation. Also, with equity, like in the startup world, equity vests, right? Oftentimes, and especially in small businesses and LLCs and what have you, there aren't vesting schedules, which means sometimes someone will get a nice ownership piece up front, and then not contribute as much down the road, but they still retain all of that equity,
Mm-hmm.
which doesn't make a lot of sense in the startup world, as probably lots of people listening in understand. There is that vesting schedule to make sure that there is this consistent value exchange between the
Mm-hmm.
individual and the company.
Mm-hmm.
And so yeah, those are tricky conversations that need to be sussed out early. And it's part art, part science into how you compensate people with a mix of both cash and equity.
How did you guys go about when you got this out of the offer? Did you guys take it to? Did you guys bring on a broker, investment banker, or? And we
We
don't have to
didn't.
focus just on this sale too. Like just in general, like these concepts are just so you've had multiple exits. So how did you go about this one, and how did that reflect on the things you did on the next two?
Yeah. So with this first one, it was fortunately inbound, where someone was looking to expand, and so they contacted us. We did not enlist a broker or even let's call it a small banker or an advisor in any
Mm-hmm.
way. We basically did it ourselves. Just the brain trust of us and the investors. There were some sharp investors in there as well who had
Oh, that's
experience
helpful.
in,
Yeah,
in
yeah.
yeah in these types of transactions. And yeah, I think it was a decent outcome. All the investors got paid back their money and then some with a decent IRR. We got to relinquish any sort of liabilities on the machines that we had to rent and the space. So we had the landlords on board and everything. So it was a nice clean transaction that went really well. I was able to pay down a little bit of credit card debt that I had accrued. Yeah, so
What did
that's
you
how.
what did you learn about valuations? And pull from whatever part of your story and your journey that you want to. Like it, over the years on this show, I realized that I'm like, oh, not like my dad and I didn't understand valuations to begin with and what created enterprise value. And a lot of people learn it, that I've realized over the years, that people learn it through exiting, and that's when they learn it, which is a shame. Like what did you learn off that first one? And then how about the other two, like of what actually creates value on the, when you go to actually sell the company?
Yeah, so in that first one with Sutera, the medical spa, the what I learned was we unfortunately found ourselves in a commodity business, which at the beginning we did not believe was going to be a commodity business, but it became one, unfortunately. And interestingly enough, this is going to sound funny, but I like businesses that somewhat operate in a gray area of regulation. And that's what Sutera was. At the time, it was unclear whether you can operate a medical spa without having a physician on premises. And the regulation was gray, and we just said, screw it, let's go. We're going to do it. In the state of Florida, who's going to come after us? Let's take that risk. So we did. We took that risk, and once I think other would-be med spa owners saw what we did, and that we weren't under any legal issues as far as they knew, bam, people just jumped in. So it was what we thought was going to be a differentiated business with some moats around it. Quite quickly, we realized it was a commodity business. And what happens is, if you have a commodity business, you better have a really strong brand, which, since we only had one sole location and hadn't expanded, the brand did not have the footprint that we would have hoped. Without that strong brand, it became difficult to command any sort of premium on enterprise value when it came time to sale. So at the time, we really just had, the existing infrastructure, like a beautifully built out location, the machines, of course, a client list. So it was a what we were really selling at the end of the day was a turnkey med spa for this new owner to come in and just operate in full stride on day one, rather than have to deal with any of the headaches of setting it up. That's really what they were buying.
Yep. So then on the next few, first of all, going from med spa to like finance, super curious if like you just got like spreadsheets just injected into your blood at grad school or like, so like, curious on the like the path there, and then why you got into the next few businesses.
Yeah. So the second one, which was rewarding people for exercise, I was actually inspired while I was in business school at Columbia by this company called Recycle Bank. Recycle Bank ended up raising some decent money from some really strong venture capital firms. And what they did was they would incentivize you to recycle because they would give you reward. They would take your recycling bins, weigh them, and then that weight would turn into currency, and you could redeem those currencies.
To recycle just a huge dumbbell every so often, and then you get some solid.
So funny. You game the system, exactly. Unintended consequences, right?
Exactly. Born sales guy. Give me the comp plan. Let's figure out where the holes are.
How to get there, yeah. And so I thought, wow, I wonder if this model could be applied to exercise. And it was something that I had in the back of my mind since like 2007. 2008, how can we, perhaps integrate with the machines in a gym to see how much you worked out on those machines and give you points. And then right around 2010, Nike Plus, Runkeeper, Fitbit, Jawbone, all these fitness trackers and apps just started to come onto the market. Admittedly, we were probably too early in hindsight. They just started coming to the market, and I thought, hey, all of these services are going to have APIs built on top of them. So instead of what I initially thought was, hey, we have to integrate with the machines at a gym. No, we can go straight to these devices and apps via API, collect the data from them. Oh, my light just went out. 1 second.
Like it looks like a bar light. I love it.
Sorry about that.
Busting out the
We're
Bloody
back.
Marys already? Yeah, right.
Yeah. So we thought, yeah, all these devices and apps are going to have APIs. So let's go ahead and build this service that can be like a layer of value
Mhm.
above all of those fitness trackers and apps, and allow people to be incentivized to exercise and then use their points that they've earned to spend on rewards. And that company's called Earned It, or was called Earned It. At first, wow, this is a lesson. We had begun speaking with a company called Everyday Health on a partnership. And then that partnership conversation turned into an acquisition conversation. And we went through several months of negotiation and pricing discussions and employment contracts. All the legal and accounting review was done, and we were basically about to sign on the dotted line. This was now October of 2012. We were about to sign on the dotted line to sell Earned It to Everyday Health. What happened was Hurricane Sandy came through New York, flooded a lot of the city, and created a blackout where there was no power south of like 28th Street in New York City. Everyday Health's offices were in that blackout zone. And so when we were supposed to come to the tables, they were like, well, let's push this back 2 weeks.
Oh
So they pushed it back 2 weeks. In those 2 weeks, my first child is born. And I'm already thinking this deal's done, right? Like we've gone through all of this, right? And so we're starting to just spend a little bit more freely as if the money were already in the bank. Rookie mistake, obviously. You know where the story's going. So then 2 weeks later, when we go into Everyday Health's offices, the CEO, Ben Wolin, sits down. I'm thinking, hey, yeah, let's sign this contract. Let's go.
Give me the pen.
Yeah. He's like, so we're not going to do this deal. And we were like,
my God.
what? And so what happened was in those 2 weeks, they had a major client back out, and they were banking, and for confidentiality reasons, I'm not going to share that client, but they had a major client back out that was going to basically be a large subsidizer or buy, basically like fund it.
They were going to deploy the app or something like that to that client or something like that.
Exactly. So that client backed out, and then the ripple effect was they backed out of our deal, and it was just an absolute gut punch, but a real lesson in, hey, these things can happen at the last minute. The deals fall apart.
How long have
Do
you
not
guys
start
been?
spending.
Yeah. Oh man, the amount of times I've had people were like, they're literally, yeah, you're like, there's either mentally spending the money, and therefore they
Yeah.
call it the death by 1,000, or every deal dies 1,000 deaths, because people just want it to be over by then mentally, but other people spend the money too, and the wire hasn't come across. How long were you guys in business when you guys were doing that?
So we had started Earned It in 2010. I think we launched officially in March of 2010. That deal happened October 20th. Well, not the deal, the broken deal happened in October of 2012. So 2.5 years after we had launched. And then fortunately, a year after that, we were able to sell the business successfully to Higgy, which was based in Chicago. Also, that started as partnership discussion, and then morphed into an acquisition discussion. Met with them. They submitted an offer. I turned it down. 2 months later, I went back to them like, I'll tell you what, I would like to do a deal. Here's a minimum requirement from a cash component. We'll talk about the equity later, but here's the cash component minimum we need to see in this deal. And they took it to the board, and we were able to get it done.
So, did you have partners at that firm?
I'm so sorry.
Did you have partners at that company?
At Higgy?
Yeah.
Yeah.
Oh, no, not at Higgy, at the app that I don't know what the name of your company was. The one that you
Earned It.
Earned
Yes.
it. Yeah.
Absolutely. So I had a technical co-founder who was our CTO, and then we had three other folks on our team. So it was a lean team. We didn't raise any venture money, which, by the way, gives you when you don't raise any money, particularly when you don't raise venture money, it gives you a lot of optionality when it comes to exits. If we had raised venture money, of course, we would we would have required a much larger acquisition price, which wouldn't have been feasible. And then also a board would have to approve everything. But instead, in this case, I basically could unilaterally decide what we were going to do. And everyone made out okay. My co-founder was able to put a down payment on a house, and everyone went over to the acquiring company except for me, actually. I then, after that, was in the process of co-founding Fundera, which that's when I was brought in by Jared Hecht, who was the
That's
CEO, and
awesome.
his idea. Yeah.
So a couple questions before we get into the Fundera is with you and your partners, were you guys paying yourselves and were you cash flow positive? How did they value it? Because it's always this mixed bag, Andreas, is that like, is it a multiple revenue? Who cares if this thing's burning cash? Because like a lot of those, like on the SaaS and tech plays, and especially when you throw the VCs in, a lot of logic goes right through that freaking window. And so then, like, how did you guys get? How was the valuation? And did you learn anything in that broken deal that you did differently in that span before you ended up selling it again?
Oh, in the broken deal, what I learned was more around transaction philosophy and not counting your chickens before they're hatched, more so than anything from an operating perspective. So I wouldn't say that necessarily anything from an execution or operating the business changed in that span between the broken deal and when the deal successfully happened a year later. That was your second question. I'm sorry. Remind me the
Yeah, no,
first one.
no. How was it valued? Because like, was it
Oh,
multiple
the
revenue?
value.
Were you guys cash flow positive? And the cash flow positive is a loaded question too, because I didn't know if you three were paying yourselves market rate at like the CTO and the VP of sales or whatever you guys were doing.
So I was not paying myself anything from a salary perspective. The other four individuals on the team, including my CTO, were paid, but absolutely not market rate at all. I think once you weigh in the acquisition amounts, and then kind of made them whole. Admittedly, not entirely,
Mm-hmm.
if I'm being honest.
Mm-hmm.
But it did get very close to making them whole on what would have been a market rate cash compensation. So because they were making less than market on a salary and a cash basis while we were operating the business, we were profitable. We had to be, because I wasn't able to fund the business from my own personal account, and we
Mm-hmm.
hadn't raised any outside funding. So the
Mm-hmm.
business had to be funded by our customers, by our clients. And so at that point, though, to get to the valuation answer, it's tricky because we were acquired by a private company with both a cash and equity consideration. So
Okay.
when you're being acquired by a private company, they can value you at $1 billion, and that's, hey. But now the other math you have to do is, well, how are they valuing their equity? Because if they're like, hey, John or Jane Doe, we think we'll buy you out for $1 billion. Here's $100,000 in cash, and the rest is in equity in our company that we think is worth $20 billion when it's worth remarkably less. So when it's private company equity, there's that extra step of, well, now we need a line on your equity on because that's the conversion we need to do under the hood, right? Which it gets tricky.
It's so interesting, Andres. We have and one of our clients that has our CFO services that with private equity, when they want you to roll a bunch of money back in, very few people like actually know this or like understand it to the point where they act on it. Is like, you're now an investor in that company, so you can
Yeah,
actually do reverse due diligence, just like you were saying.
absolutely.
And like all the logic applies, man.
Yeah, you've traded one lottery ticket for another lottery ticket, but don't be fooled. You're still just hanging on to a lottery ticket.
Exactly. Yeah, there's no cash. You don't know whether you're getting 30 years or
Yeah,
whether you're getting over 2,000 years.
that's right. Now, sometimes I'll tell you what, you look at some public market examples which are fun to look at. For example, Twitter, when they were worth about 60 or 80 million, acquired a Twitter search engine called Surmise. This was way back. I mean, we're talking maybe 2008, 2009. They bought Surmise for maybe $10 million when Twitter was maybe worth 60 million. So basically a sixth of the company. So Surmise actually was a several $billion acquisition when you really look at it, which is interesting.
Right? Isn't that? Is it? Yeah, those founders, the people that got that equity swap, are not doing too bad.
Yeah, I mean, it really worked out for them. Really worked out.
So your other co-founders ended up staying at the
They
acquirer then?
did. They stayed at the acquire, and then I went on to co-found Fundera with Jared and Rohan, our CTO. I will say one last point on. I think what made the Earned It acquisition successful was we made sure that we were in the orbit of potential acquirers, and I think that's important because you'll hear the mantra that companies are bought, not sold. And frankly, I think that's bullshit. I think some companies are bought, not sold, but chances are, all of us on this call here are not one of those companies that are bought, not sold. They need to be sold a little bit. And to do that, you don't necessarily go around saying, hey, we're for sale, because then there's a discount on applied to you. But you just make sure that you're in that orbit of potential acquirers. You make sure that they know, and you can really highlight and spin a little bit your progress, and the fanatical clients that you have that love you and stick with you, and you really tell that story in a strong, nice, beautiful narrative. Eventually, believe me, their ears are going to perk up and they're going to think about acquiring you.
What is your definition of orbit? And maybe give us a couple examples of how
Yeah.
you acted on it.
I would say in an orbit, you want to perhaps set up partnership discussions, ideally even partnerships. If it's potential acquire that's competitive to you, sometimes it is good to keep your enemies close. And so they say the devil you know is better than the devil you don't know. And so, hey, every quarter or so, why not go and grab drinks or break bread with the CEO of a competitive company? And you're not going to get into sharing these super trade secrets or anything like that. They may not know, but everyone can peacock a little bit in those meetings, and eventually, those competitors are larger than you, they may want to buy you out as well if you continue to tell a really nice story over and over again. But it's an investment, right? I mean, you probably want to be in setting up those quote unquote orbits for 1 or 2 years.
Mm-hmm.
It's not going to happen in a matter
it,
of months,
Yeah, I think it's very consistent with some other stories I've heard. I mean, like those partnerships allow you to, and then both of you end up knowing each other, how you work better, and you get through due diligence faster.
Yeah.
And there's actually like you get the emotions going. It levers that peacock, right?
That's right. That's right.
So why did you after 2 exits like this in wildly different kind of operating entities, like where was your head at, Andres? And like as far as like why Fundera, why going after that, why number 3? How did where were you at with your mental mindset?
That one had landed in my lap. So Jared Hack is one of the smartest people I've ever met in my life. Just an incredibly sharp guy, incredible entrepreneur. Before that, he had co-founded a company called GroupMe, which was one of the first group messaging apps. And he had a successful exit from that, sold it after a year to Skype, actually, and then Microsoft acquired Skype. So he had a 2-year retention period at Microsoft, and basically at 2 years and 1 day, he says, "Hey, Andres, can we go grab coffee?" I was like, "Sure." At the time, I'd actually just given verbal acceptance of a job offer at an ad tech company to go be like an SVP. And it was only a verbal acceptance. I hadn't yet signed the letter. I do feel badly about it with what I'm about to tell you, which is, I go and have coffee with Jared, and Jared's like, "Look, I have this idea for a business. There's all these alternative lenders, like non-bank lenders that are coming on the market. It's going to be a very fragmented market, already is. Basically, I want to create almost like the common application in college where you can it's like an aggregation play where through one channel, you can get access to all of these lenders as opposed
like
to going
or something like that for travel or something like that.
Yeah, it's almost like what we used to be called kind of like a kayak for small business loans. You just
100%.
Yeah.
Yep.
And so I thought, wow, this is very interesting. I love aggregation plays. I love marketplace companies. So it really, really piqued my interest. And again, I really respect Jared as an entrepreneur and his intelligence. He had previously, we had talked about me joining GroupMe. The timing just never worked out. So we had wanted to work together in the past. And so I thought this was a phenomenal opportunity for me to do that. And so I had to go back to that company that had made me the offer that I verbally accepted and said, "Listen, guys, I hate to do this. I actually do feel terrible, and I admit it's not a great thing to do, and I'm a bit ashamed of it, but I had to kind of renege on that.
Something came across you couldn't refuse.
Renege on that acceptance and go on and start Fundera with Jared and with Rohan, who was our CTO. I had never met Rohan before, but Jared brought us together. So Fundera was really Jared's brainchild, and he was CEO. He continues to
Was he the tech person too, or like what was the like on ground zero? Like what was everybody's roles and
yeah.
how was the funding and equity
So yeah,
structure? You don't have to give percentage or anything
yeah,
like
no,
that. Just
no,
like what was
no,
the conversation like?
for sure. And this is also like an interesting lesson learned. So Jared was the mastermind behind everything. He was the real ringleader. Rohan was the technical chops and our CTO. We got everything going. And then I was brought on board to structure all of the lending at first, to structure all of the lending relationships with all of these non-bank or online lenders. And really, we were the first company to come in and do that at a large scale, to aggregate and be this like channel into these lenders. And so it was somewhat uncharted territory to be doing that. And so that's what I was brought in to do, is
The gray area, right?
yeah, the gray
Gotta
area,
love it.
the partnerships, the outward facing like commercial stuff. Jared was responsible for the fundraising and again being the mastermind and early key hires. He did all that and he did it exceptionally well. So yeah, and then I was doing all of those partnerships conversations. In terms of equity, and this is going back to something I'd mentioned earlier around thinking through like that balance of cash and equity. At the time, I was I was a new father, hadn't accumulated much wealth, so I'm living in the West Village of Manhattan. Like I have a high like personal burn, right? Unfortunately.
Yeah, exactly.
And so
get up and go to work, man. Pay the bills.
yeah, and so that's why I was going to go, be this SVP of that company that had given me that offer. And so I said to Jared, I was like, yeah, unfortunately, I do have a certain like baseline that I need to cover of this personal burn. And Jared said, that's no problem. We'll do that. So I had a more at market wage from a cash basis. Frankly, and at first, Jared was paying that out of his own pocket until we closed on the round, and then that the investment capital then would take care of that. Because of that, I had a much lower equity stake than one would think your typical co-founder would have, and that's okay. I mean, that was the decision and the arrangement I needed to have in the early days. Of course, now after the acquisition that happened last October,
You just run some straight line math, and you're like, oh shit.
yeah,
right?
man, like yeah. But listen, I've learned it's hard to regret decisions. Regret's an emotion that I try to avoid. It's probably an emotion that I hate the most in life, is the emotion of regret. And there are several things I've regretted in my life. One of them was not being the first investor in Airbnb, and I can get to that story later. But what I try to tell myself is, at the time, the situation, the scenario you're in, the context you're in, the amount of information you had at that time, that was the decision that you came to, and it was right at that time. Sometimes, yes, eventually those decisions, with the luxury and the advantage of hindsight and many years of seeing other cards unfold, okay, maybe it wasn't the right decision, but at that time, that was the right decision. And so you have to live with it, not allow the regret to eat at you too much. And so, I don't regret that decision that I made from the cash and equity standpoint with Fundera. I had to have that cash at that time. And
It's
then
very wise of
Airbnb
you,
was
man.
different.
Honestly, no, it is, because like regrets. I mean, honestly, this whole podcast 5.5 years ago started with people sharing their regrets. I mean, that was like the entire show. And you're so right. Like it's hard intellectually. Doing what you said makes sense, but it's just then you throw the emotions that are in your stomach, and it's hard to reconcile the two sometimes.
It's tough, man. It's tough. Yeah.
So what was so you raised some funds, and I don't know exactly whether there's institutional investors, like, or if it was a seed round with family and friends, but like, what was the timeline of that business? And you had mentioned when we jumped on that you had parted ways from like the salary perspective, but kept the equity. Kind of walk us through how that all went down, how the conversations went.
Well, yeah, that one with Fundera. So I was there a couple of years. What happened was, so after I'd set up all of the lending relationships, I then was brought, like my mandate shifted to, hey, set up, think of it as like customer acquisition partner channel relationships with large companies. Think companies like QuickBooks, like Intuit, and just large companies that have huge installed bases of small business customers. That was our target customer. What we learned as my mandate shifted to that was it was still relatively early in the online lending and alternative lending space, and frankly, there was almost some distaste of alternative lending and online lending. It was almost like
A
a
little bit
for,
different than today's.
oh yeah, it's way different than today. It was
Like
almost
pay now or buy now, pay later, and like how many of those companies can you have? You don't
oh
have to buy anything these days.
yeah, they're killing it. Yeah, the buy now pay later folks. Actually, Klarna was really just starting to really take off back then when we were doing Fundera. It's amazing to have seen their growth. But back then, alternative lending and non-bank lending was a bit of a four-letter word. It was marred with stories of predatory lending. And in fact,
Hmm.
Fundera's purpose is to actually help business owners avoid predatory lending, make sure that they are
Transparency behind that, right?
yeah,
Yeah.
making sure that they have a concierge and an advocate in their corner to make sure that they do get the best deal possible. However, when an entire industry has that reputation, even if you're the good actor within that industry, you get a little bit marred by it. And so a lot of these
Hmm.
larger companies didn't necessarily want to align with online lending. And so we saw that what we thought was going to be a huge customer acquisition channel for us with these large companies ended up not being the case. And so it was like, okay, well, since that's not going to bear the fruit that we thought, and that was basically what my mandate was at that point, since a lot of basically all the lending relationships were already in place and doing well, maybe it was a good time to step away from the business. And so that's what happened. And so I stepped away from the business for a couple of years. There was vesting that and some shares that, of course, were left on the table because typically in startup land you have a 4-year vesting schedule. So there were options and equity left on the table. But listen, I still had a meaningful amount of equity, and so I'm not upset by the outcome. Following the acquisition last year. Of course, yeah, it would have been nicer to have been either fully vested or, had been able to have a below market salary in exchange for a higher equity when I came on. But that wasn't the reality that I was living in at the time.
What was it like just having the equity and not working at a company that you had helped co-found like that? I know it wasn't your baby idea, but like, you're on ground zero, man. You got a lot of personal, emotional investment into like what this thing is. Was it weird taking a step back?
Of course, it was very weird because it was something that I was obsessed about for a couple of years until all of a sudden, you know, when you're falling asleep at night and you're thinking about the business, you're like, oh wait, that's right, I'm not working in it anymore, right? But you're
Right.
still you're still like the biggest champion and advocate and evangelist out in the market as best you can. But yeah, I mean, it turns out, I have over the years, I had plenty of those lottery tickets, right? So, Earned It was acquired by Higgy, which was a private company. So I had that private company lottery ticket. I had the Fundera lottery ticket. I had the Outbrain, which is a company that I was working at full time while I was doing Earned It on nights and weekends. So Earned It wasn't, believe it or not, my full time thing. I was doing that on the side
Mm.
when I was
Oh,
working at
interesting.
yeah, when on the side when I was working at Outbrain. That's why I didn't need to necessarily pay myself a salary because I was already being paid market rates at
Got
Outbrain.
it. That makes a ton of
So the
sense.
Outbrain lottery ticket, Outbrain actually just went public this past summer. Although I'd sold all of my Outbrain shares on the private markets in a secondary sale in January, all of my equity. And then 3 months later, or 4 months later, they say, "Hey, we're going public this summer." I'm like, "You got to be fucking kidding me!"
Oh my God. Jesus. Oh, what a bummer, man.
Yeah, man.
No, but so you were cashing in these lottery tickets to actually yield yourself some actual capital.
Yeah, yeah. So these lottery tickets have also, I guess the maturity date on these lottery tickets when you're dealing with private company stock, they tend to be several years. It just so happened that the outcomes of these lottery tickets are now starting to come to fruition. So, the lottery ticket I had with Higgy unfortunately isn't, I don't believe, going to yield anything anymore. So that one you could rip that lottery ticket up, and that happens. The Outbrain one I was able to sell in the secondary market, so I was in the money there. Fundera, the acquisition happened last year, so that lottery ticket came to fruition with positive outcome. I still have a lottery ticket here at Wonderkin, meaningful amount of equity here. So we'll see what happens there. I think we're on a really great path and trajectory. So I'm very bullish that that lottery ticket also will lead to a positive outcome. And then now lately, I've been making some angel investments just to increase the number of lottery tickets I have because it's fun, man. Right? Like same reason that you go and you play the lottery.
That's
like,
why
hey,
you get a lottery ticket. Yeah, that's
yeah,
exactly right.
let's see what happens. And you don't expect them all to pay off, of course, but so far, the hit rate's been really strong.
Well, and I want to talk about Wonder Kid a little bit, and before we do that, so because of the multiple roles that you have, like when you think about your identity, like what do you place it on? Is it the gig that you're working on immediately, or is it where you have your equity in the lottery tickets, or is it like as a serial entrepreneur? Like I'm just like, where do you place it? Because I think a lot of people that stick with one thing for so long that it's so devastating
Yeah.
when they have to part ways from that. How have you kept yourself baseline?
Yeah, my identity lately has actually been very Wonderkin focused, which is typically if I'm working at a company that I didn't start myself, my mind just starts to wander and go into more entrepreneurial endeavors. And so I get distracted. Wonderkin is not a company I started myself. However, I have a real strong sense of home here, a sense of belonging, a sense that I am making an impact to the company with the business unit that I'm effectively the CEO of a business unit within the company. And so I feel like I'm entrepreneurial in that capacity. So
Mhm.
I do identify a lot with the business unit that I run and with Wonderkin as a whole. And so my mind has not been wandering into, hey, what else could I be doing from an entrepreneurial perspective, which is a beautiful thing, right? To know that
How did you find it? Like what else were you looking at? And some more context behind the question too is again like I actually said at one point like I'm professionally unemployable, like because I because I
I'm
had to work for myself.
I agree with that. I completely agree with that, Ryan. Like I find myself professionally unemployable too, for the most part. Except here, I report directly to our CEO and founder. His name is also Ryan, by the way.
Nice, you
And
must be a good guy.
yeah, he's a great guy, brilliant product visionary. He's so sharp. I've known him for 11 years because
Oh wow.
he was doing. So when I was running Earned It. Remember, we were getting allowing people to get rewards from brands. One of
Hmm.
those brands, which was one of Earned It's clients, was a company called Bonobos, the men's clothing company. And Ryan was working at Bonobos in customer acquisition, and so Ryan was basically my point of contact, or became my point of
Oh,
contact
interesting. Yeah,
at
yeah.
Bonobos. We met in that context, and so after selling Earn and what have you, he and I of course continued to keep in touch, and he was telling me his idea for Wonderkin at the time. It was Bounce Exchange, and he just told me the idea for Bounce Exchange, and he wanted me to join in the early days, and I didn't because I went off to start Fundera and just doing other things. But then 5 years ago we reconnected, and he told me about this business unit that he was looking to build out. At the time, it was just nascent. This advertising media based business unit within the company, and I was like, yeah, this sounds really interesting. And so I came on board and have helped build the
Were you
business.
looking at anything else?
I'm sorry.
Were you looking at anything else, like other gigs at the time?
I really wasn't actually. At that time, I was considering starting this company called Vestable, which is a marketplace which was going to be a marketplace for buying and selling small businesses. And this is now, 2016 timeframe. So this was
Hmm.
before Micro Acquire and Quiet Light. A lot of these, before a
Hmm.
lot of these marketplaces for buying businesses really became popular, or most of them weren't even started yet. And so
Hmm.
I wanted to take the learnings from Fundera and having a small business marketplace and how to acquire small businesses,
Oh, interesting.
and create this marketplace for the buying and selling of small businesses. So yeah, that was the goal, was to, hey, can we do this? And so I did it with a friend of mine, someone I knew by the name of Pir. And so we started working on that together for several months, and started having some conversations with investors. It turns out we weren't able, and this was 2016 when things were remarkably different from a fundraising context than they are now. Now, it's
You have it. Can you breathe here? Would you like some capital?
yeah, I know. And I actually, it is the case, and it seems to be the case. At least that's what you're reading in all the headlines. Although that's got to be really frustrating for people that are struggling to raise money because they're
Find
like,
it.
all these people seem to be able to raise money like on a whim. But what's happening to me
I
in my
think the
business?
funds, the VC funds and the PE funds and the aggregators can raise funds really easily, but the companies are still having a hard time because you got the gatekeepers
Yeah,
that now. I mean, it's interesting dynamic
it,
going on right
it, it
now.
is. It is. But back in 2016, it wasn't nearly as frothy as it is now. And so we were trying to raise money, and for good reason. I think there was concern from investors and concern from really sharp people that we spoke to in the market around, can you actually take this transaction and make it online? Can you take it this offline business broke? Because what we were wanting to do was to actually replace the offline small business brokers, right? And there's tens of thousands of these online small business brokers, and they don't have the best reputations. Which, if you think about it, what we were trying to do with Vestable in replacing these somewhat what are perceived as shady small business brokers is similar to what Fundera was doing to,
Right, just a marketplace. Yeah, just transparency.
yeah, transparency and be the good actor in this space.
Hmm.
But I think the selling and buying of a small business still requires so much diligence and transparency and like real world connection between buyer and seller that a lot of these investors we were speaking with just didn't believe we can bring this transaction online. And so we weren't able to raise the money. And so I was like, okay, well, I think, rather than continue to bang our heads against the wall with trying to make Vestable a funded, viable startup, it was, it just, the timing worked out that that's right around the time that spoke with Ryan. He's like, hey, do you want to come build this business unit? I was like, yeah, let's rock. And
What I
man, it's a
find what's
brilliant,
super interesting about the opportunity that you had is that I so many people that I know that have sold or they like there's always the what's next. You know what I mean? Like so like how do you go into this next stage after your current company that you sell, whether you are financially free or not? I mean, like all those are just there's all these like potential variables, but the big question is like how do you land somewhere with the right combination of risk and upside and the ability to kind of reinvent yourself, especially if you're professionally unemployable, like we talked about.
yeah,
I love hearing that that you've landed a place where that you're not just trapped as like an entrepreneur, that you've been an entrepreneur. And I hope that there's people out there that like take something from that, because I think people honestly they go buy a company when they shouldn't, or
right.
they go like I'm now this, I got the Midas touch, so I'm going to spread my wealth into all these companies, and they all like they don't pan out the way they do. So
Yeah.
like people just don't know what to do honestly afterwards.
Yeah. Yeah. Let's be honest. As we all know, entrepreneurship is a slog, right? Like it is not glamorous. It is just like, man, like it's rewarding and fulfilling and, enter here all of those adjectives. But another adjective that we can't ignore is that it's a pain in the ass, right? And so sometimes there is a luxury not like going on and just starting the next thing again, or buying a business and being the sole operator of that business or the head of that business. There is a benefit to going to, let's call it the comforts of a larger funded
Hmm.
company. And I'd say for those super entrepreneurial minded people that are probably most of the people listening on this call, if you're thinking maybe I don't want to go on and do something else and be an entrepreneur again because of that slog, find an industry that you're passionate about and maybe go to some of the large players in the industry, be like, hey, there's this business unit or here's this business you should consider, and bring me in to build this business for you within the confines of your company. And you could set it real success metrics there. Make sure you get there's some risk and reward for both you and the company. Maybe
Hmm.
they do pay you perhaps some sort of market or below market rate, but really the money will be had in, hey, if you can build the successful business unit, that the real reward is down the line in building
Hmm.
out the business, and de-risk it for that large companies. Say, hey, we're going to share in
Hmm.
the risk here.
I love it. Yeah, so much truth in what you said. So what is WonderKid? And like, I think what you were describing, what it does helps also online companies grow value by realizing where more money is. So why don't you give us the overview of it
Yeah, the
and
rundown.
what you've been up to?
Yeah, absolutely. The rundown, and it's something that can be considered almost like a marketing operating system. And so what that means is as the owner of the online business or a marketer for an online business, we're able to execute on-site messaging and on-site campaigns so that we can see each visitor as they come into the site. What are they doing? What's their historical relationship to your company, to your site? Also, what are they doing in session right now in real time? And then we can create dynamic one-to-one messaging for them on site to pull them down that conversion funnel. If they end up not converting on site in that session, which most visitors don't convert in that same session, we're able to then send a series of emails to them. If we know that you have the
Mm-hmm.
permission to send this individual an email, and
Mm-hmm.
we can match this visitor to an email that you have in your file. If you're allowed to send them emails, well, then we will then trigger this series of emails that will go to them about maybe items that they looked at or items that they even left in their shopping cart. It's called triggered emails, and we're able to scale
Mm-hmm.
those. Triggered emails perform really, really well for online for e-commerce companies or even for media companies that sell subscriptions. They work really well. The problem is they can only sell them to like a very small percentage of their visitors. We help increase that percentage of the number of people that we can identify, and they're matched to an email that you have on file, and then allow you to
Mm-hmm.
send those triggered emails. So we're doing these on-site executions. We're doing these triggered email executions. We can also do that through text message and capture the text messages on
Mm-hmm.
site, or excuse me, capture the phone numbers on site and send them triggered text messages in the same way that we capture email addresses on site and send them triggered emails, through in subsequent sessions. And so that's why we call it that marketing operating system. We have your on-site messaging one-to-one taken care of, your email messaging one-to-one taken care of, your text messages one-to-one taken care of, and also through the media business that I oversee, those one-to-one messages in ads and advertising that goes across all of these premium media sites where that work with us to show our proprietary ad formats.
Well, and what's super interesting, Andreas, is that like I think about like the e-commerce, the online businesses that we work with, their whole goal is they're scaling their company to grow more enterprise value. And like so one of the big metrics is client acquisition costs, like how much ad spend and like what's the lifetime value of your customer. Well, you look at the levers that you can pull from the financials and you go, okay, well, more clients and reducing the client acquisition cost, but then it's looking at the churn and then the lack of conversion on the back end that you're talking about that could literally drop some significant money to the bottom line. I mean, yeah, it's interesting. Go ahead.
Yeah, no, that's spot on. They spend so many companies, they spend all their money on, that top of funnel. Google and Facebook
Hmm.
tends to be where most of those acquisition budgets are spent. But yeah, they have leaky bottom of the funnel, and we help patch up
Hmm.
those leaks, right? Like, let's help you get the best ROI on those acquisition dollars.
Hmm. I gotta tell you, just the most ridiculous cart abandonment story. So because I spend probably too much time in this space too with a lot of the online entrepreneurs, and so I know about these things. And there's these shirts that I'm actually wearing one right now called Fresh Tees,
Okay.
and I just was like, well, so I put all this shit in my cart because I also know that they've got this tool. So then I get the 50% coupon off tomorrow.
Yeah.
So I like actually
Well,
go in there and leave it there on purpose.
that's you're hacking the system.
I know.
Like,
It's
you're
awesome.
hacking the system, and we Wonder can for a lot. I don't know if we work with Fresh Teas. Actually, I should know that.
I don't know. Yeah,
But
should have maybe
yeah,
left it anonymous, but
we're the engine behind that. We're not necessarily the ones proposing, hey, Fresh Teas, you should do
leave it in your
50%
cart.
off. But we do power that technology behind the scenes. But that's smart. I'll tell you what, though, Ryan, by you doing that, and again, I don't know if we work with Fresh Teas, so disclaimer. But if you do that, we get great credit for that because it was our triggered email that went to you that then you
Good.
converted
I'm
off.
glad I'm
So,
supporting.
yeah, please keep doing that.
Oh, that's awesome. But all joking aside, outside of me. I mean, most of those people, like you've already paid for all the ad spend, so it's gonna drop right. The money's gonna drop right to the bottom line
Yeah,
because they're already sitting there.
that's exactly right.
Dude, this has been a blast, man. I'm
Yeah.
so happy that you were able to share the journey with us. Two questions.
Rock it out.
What does the word intentional mean to you? Because it's the name of the show. Just love the word, means a lot to us. So what does it mean to you?
Intentional to me means very thoughtful, very fulfilling, outcome oriented, where, yeah, your heart is in it and you identify with it.
Awesome. 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 Where can where can the listeners find more about you, Wonder Kid, and any of the things that you've been doing?
Yeah, I've been telling folks, feel free to email me. I love receiving email. My inbox is sometimes my to-do list. I guess it is for a lot of folks, but that's where I tend to connect most with people. I mean, of course I have LinkedIn and Twitter, but honestly, I think email is more personal, and that's where I'm happy to engage. And my email address is Andres, which is ANDRES at wonderkind.co, and Wonderkind is WUNDERKIND.co. We're working on the .com, so for now, just keep the M.
That goes fine.
Yeah.
It's all good. Andres, this has been so much fun, man. I appreciate you coming on the show.
Thank you, Ryan. Really appreciate it.